Good morning, everyone. Welcome to this update for global stocks and commodities for the 2nd of February. There's obviously quite a lot of media attention and, to a degree, some fear around this coronavirus, which is spreading out from China. And it's pretty easy at times like this to get distracted. The market is starting to move around in a fairly volatile fashion, and it's easy to get distracted and lose focus on what is the most important thing, and that is the macro trend. So that's really what I want to focus on today, because there's certainly a lot of noise out there at the moment, that's for sure. All right, so my very firm view, and I've contemplated this pretty much all last week, is that there really is no basis for taking any sort of radical action. And unless you're a particularly nervous investor, then there's really not much of a basis to do anything at all, other than maybe raise a little bit of cash or something by trimming some profits or something of that nature. But really making decisions based on what is, because there's a lot of projection, there's a lot of conjecture going on about how far this virus might spread and what impact it might have. That's all just guesswork at the moment. So decisions need to be made on what is happening, what is factual, and that remains the only sensible course of action. So I'll explore that further. Portfolio analyst last week, I did quite a bit on entries and management of 10 baggers. In other words, focusing on what it is that we can control. So American stocks ended up falling by 70 points across the week, with two big down days. So that was a total of 4% for the week. So that's a big down week, and one that is much larger than we've seen for some time. Now, last week I spoke about the fact that the market hadn't even retreated to the 50-day moving average, and in fact may come down based on what we've seen before. So based on what is, may come down to between the 50-day and the 200-day moving averages. And we'll look at this chart in a minute. And that would have been about another 100 points down. Well, we retreated 70 points of that 100 that I talked about, and the index got down to the 50-day moving average. So we've at least ticked that box. Bullish sentiment, which had built up during January and had really become a bit worryingly euphoric during January, and we did see this a couple of years ago, that has just suddenly collapsed with this spread of this virus, and that's actually a good thing for the sustaining of the bull market, because you just don't want things to get overly bullish, and the market had deviated to the upside to a bit of a concerning degree. So frankly, at this stage, I see this as being a healthy pullback in the market. Now, you could spend a lot of time and agonize about what this market is going to do, but that is absolutely pointless. So from my point of view, because it may never happen, and it's just purely guesswork, so it's a completely redundant exercise. So I strongly suggest that you just forget about all that. Just assume that the 50-day moving average will hold, because in a strong uptrend, which is what we've got at the macro level, the 50-day moving average tends to support prices. Now, sometimes prices might go a little bit below the 50, and we've seen that in 2019. So I'm not saying that the 50 will be the absolute support, but let's assume that it will hold, because we don't have any evidence to say that it won't. And then if the 50-day breaks and breaks in a fashion that becomes concerning, then deal with it then. But don't worry about what might happen, because it's just a complete waste of time. And that second guessing of the market rarely works, because generally then people start deviating away from their trading plan or their investing plan. And then once you've changed something, it's then very difficult to get back on course. So it's just a completely redundant exercise. So that's my really strong message, is just assume that there will be a continuation of what there has been. And generally over the last 10 years, that's absolutely been the best strategy. I can categorically say that this virus will not end the bull market. It might cause some disturbing volatility, but it's not going to end the bull market in itself. This is just an excuse. The market was strongly overbought. It needed to pull back. This happened to be the trigger, but it could have been a number of other triggers. It could have been something the Fed said, or it could have been some lackluster earnings results. There could have been many things that caused this pullback. It just so happens the virus stepped up at a time when the market was way overbought. And it's at this stage, it's nothing more than that. Stay focused on growth stocks because they're simply safer. And I've talked about this repeatedly over recent months. And I want to show you an example today of just how dangerous some so-called defensive stocks are. To me, if you want safety, stay with growth. Yes, some growth stocks might be more volatile, but at the end of the day, if they're growing their earnings strongly, then they will recover. Whereas some defensive stocks that are very low growth may in fact struggle. Now, the US dollar slightly lower to 97.36, and the 10-year yield has come down quite sharply from about 1.84 down to 1.5, and that's basically because money's been flowing into bonds, so going into safe havens, bonds and gold. So let's take a look at the S&P chart. So this was the little green box that I put in there last week, and that was merely a reflection of the fact that in previous pullbacks, we got one in May, we got one in August, we got another one in October. The S&P pulled back to between the 50-day, the blue line, and the 200-day, which is the red line. And so that was a reasonable point to expect a pullback. And you can see that this acceleration that we got in January took the market to about as far as it ever gets above the 50-day moving average. So it just had to pull back. Now, as you can see, it pulled back precisely to the 50-day on Friday night, bounced a little bit. Whether it comes down further into this area here or not, I don't know. And frankly, I don't care. It doesn't matter. You know, my focus remains on the high growth stocks that we've just had a absolutely stunning 2019 with, that are growing their earnings very strongly. And to me, that is just the most productive way to go about engaging with the market. Let's look at the US dollar index. Now, I've put this on a weekly basis now, just to make it a little easier to view. So clearly we had an uptrending channel. We dropped out of that channel in early to mid-December, and we've just we rallied back to the channel, and we may now be rolling over again. And just as a recap, and I did this a few weeks ago, but the things that are in favor of the US dollar falling are the fact that Trump wants it down and is putting pressure on the Fed to do that. And this is an election year, and so he's going to keep up that pressure. And secondly, the futures market for currencies is very much positioned for a sharply lower US dollar. So, you know, that's probably, now that we've broken this trend channel, that's probably the path of least resistance to the downside. While I'm here, let's look at the Australian dollar. And it was only on the 31st of December that the Australian dollar was trading above 70 cents. And now we've just collapsed back down to 66.9. So it's been quite a dramatic decline in the Australian dollar. Looking at Australian stocks, so 66.88 is where we finished. And that's really, I've been talking about this balance between the fact that if global growth was picking up, that would be good for commodities, that would be good for Australia. On the other side, we've got a weak local economy. So those two things were that's been the tussle over recent months with the Australian dollar. But in the last week, just fears around global growth has really caused commodity prices to fall, and that's taken the Australian dollar down. Now, our index fell 73 points on the week, which was about 1.1%. We're obviously going to fall sharply, I would expect, on Monday. and energy and materials were the weakest sectors by far last week, and particularly on Friday. And of course, so that's the commodity end of things. The best performers in our market have been the technical disruptors. Pardon me. The technical disruptors that have been just such wonderful performers over the last couple of years, and by an absolute country mile. So, it just comes back to this continued theme of stocks that have got high probability growth are the ones that are outperforming by quite a long way. And as I've been saying, safety is not to be found in the majority of defensive stocks. So if that's where you feel disposed to go and ride out the storm while this virus plays out, then my message is that it's just not the safe haven that you think it is. And let me give you an example. This is just one example of a typical defensive infrastructure stock. This is TCL, Transurban, and I'm showing you their earnings, their dividend, and their PE ratio over the last, from 2017, and including the projections for this year and for next year. So you can see the earnings per share in cents there, 11.6, 22, negative in 2019, 14.4 and 19.5. Now, I know that these sort of infrastructure stocks do funny things with their accounting, and that you've got to take those earnings numbers with a grain of salt. But my point is still valid when you look at the PE ratios that, people have been chasing yield to such a degree that they've forced the price of these defensive stocks, or so-called defensive stocks, up, which has done two things. It's pulled the yield right down, so this yield is no longer 7-8% and highly attractive. It's now down to about 3.5%, and it's pushed the PE ratio up to stratospheric levels. So this year, Transurban is trading on a PE of 100 or over 100. Now, again, that's because of the way that some of the accounting is done, but nevertheless, you could not put your hand on your heart and say that that is a defensive, low-risk stock to be buying into at this point in time. It just isn't. And so, you've just got to be really careful about where your money is going in this sort of environment, because things are not as they seem. Okay, let's just have a quick look at the Australian index. So this is the ASX 200. So we did break out above 6,900. We tracked higher, but I would expect that we'll pull back below 7,000, or almost certainly pull back below 7,000 points, and there could be quite a drag on the early part of next week. If we just look at some of the other sectors, there is the energy sector. These are all daily charts, so you can see quite a sharp move early in the week down in energy. Banks managed to hold their ground, but I still see them as dangerous. Healthcare has been doing extraordinarily well thanks to Cochlear, CSL and ResMed. And there's the materials sector as well, so BHP, Rio, Fortescue also under pressure. Now, while I'm here, let's look at the gold price. This is gold on a weekly chart, so you can see we've had our consolidation. We got to the low end of the channel, which is quite a steeply rising channel, and then we've really taken off again in the last handful of weeks. So certainly gold does look very robust, and it really needs to move above this peak that was formed about 2 weeks ago. And after we get past that, there really isn't any resistance until you get close to $1,800. So there's a lot of clear air above gold at the moment. Now, this is on the daily chart. And again, this is what I put in there last week. I haven't touched it. So we had our blow-off top. We pulled back. I suggested that it was probable that we would get an ABC correction. So this is the A leg, this is the B leg, the bounce, and then we get a downward leg, which might either be short or longer, didn't know which. it's now getting pretty hard for me to argue that correction uh, is going to continue to play out. I'm still a little bit cautious because gold stocks are not leading, and gold stocks normally lead in both directions. And as you'll see from GDX, they're looking a bit weaker than this. So that sort of just slows me down a little bit. But it's getting the gold price is getting a bit hard to deny at this point in time. So let's look at GDX. So you can see it just hasn't been leading the way with gold. So that's my caution. And secondly, of course, is the futures overhang, or the bigger imbalance in the futures market, which really favours gold being sold rather than bought. So that's our situation with precious metals. So gold rose nearly $20 to 15.89. The big picture trend is unquestionably up. Yeah, I'm finding it harder to stick to my stance that we've still got a bit of a correction to go yet. Buying more gold stocks has to be done as you would do with buying any other stock. So I wouldn't just go and buy gold stocks because there's a bit of a panic on and you think gold is the place to be. You've got to do it the way that we should be doing it with every stock in the market, only by weakness, so that you are minimizing your short-term downside. There's some things in the market we can't control, like obviously what prices do in the short term and what the Fed does and all those sort of things. But there are numerous things that we can control. So focus on those. We can amend our entry process. We can be more demanding of a lower price. Otherwise, we just stay in cash strategically. We can control our exposure. We can control how we take profit. We can control our overall discipline in not getting sucked into the media hype about what the virus might do. So my strong message is to work on what you can control. Other commodities, copper fell sharply down to 254, but I do notice that base metal stocks are doing better. So this is sort of the opposite to gold, where stocks are doing quite okay. Now, crude oil, West Texas Intermediate crude, has basically collapsed since the Iraq situation, which caused quite a spike up in oil prices. Closed down at 51.46, and that's obviously around fears about economic activity in China, and therefore how much oil they would be importing. There's the spot copper chart. You can see it's been a meteoric plunge from 284 down to the low 250s. The inventory levels have kicked up a bit, which has had some impact, but it's not the whole story. Certainly there's just an element of the futures market trying to anticipate what is unfolding. Nickel has also fallen a little bit as well, but is holding up for reasons that I've discussed before. So my final thoughts, I still believe this is a buying opportunity setting up. Now, we're not there yet. It is too early in the game, and the S&P and global markets could decline another 3 to 5% yet. But a buying opportunity is setting up is the only conclusion that I can come to, because all the other macro things are in place. You think about what the market was worried about in 2019. There was the trade war. There was, situation in the Middle East. There was Fed and the interest rates. Well, all those things have been pretty much resolved. We came into this year with really nothing much for the market to worry about. Now, the coronavirus has come on the scene rather suddenly, and that's changed the picture. But that in itself is not going to influence the bull market. You've only got to. These numbers may not be exactly correct, but I read yesterday that the identification of the genome around this virus, if you go back to 2003 with SARS, it took apparently something like 5 months for them to map out the genome. This time it's taken them 5 weeks. So medical science has got a heck of a lot better. So there's no reason to suspect that the coronavirus is going to be any worse than some of the other so-called disasters that we had. So I think a buying opportunity is setting up in the market. Avoid trying to micromanage the short-term risk and reward, panicking because of what the virus might lead to. I just think it's not a good strategy. The strong odds are that you'll mess up your overall strategy, and it might take you some time to get back on track. The answer is we just have to learn to deal with the volatility, and I find the best way to do that is to set realistic expectations in advance, and then if the market does sharply volatile things, psychologically you're ready for it. And I just find it makes it so much easier to think clearly and to make good decisions. So set realistic expectations about how much stocks may pull back. And for those that are concerned about valuations, so this is always getting trotted out, and people that would like to see the end of the bull market for whatever reason trot out something called the Shiller PE ratio, which is a backward-looking assessment of market value, looking at the last average of the last 10 years. To me, it's the greatest market hoax that there's ever been. It's just plain silly because markets look forward and the Shiller index looks backwards. So just ignore it. And it's really had no impact on the progress of the market over the last 5 years, and I don't see that changing. Portfolio analyst upcoming, I haven't decided what I'm going to do this week in particular, but with the questions that we get from members, it's always I think a really productive session. So that's it for this week. There's my contact details for any non-members. It's a pretty exciting time at the moment. I'm still very positive on the market over the long term. Short term, all bets are off. I don't really know what will happen in the very short term because there's a fair bit of sentiment coming into it at the moment. But I'm just pretty much ignoring it and just I'm just trying to control what I can control and focusing on that. And I have high confidence over the growth stocks that I've been recommending through my services. So we'll see what happens next week. That's it for this week. Cheers.